So we turned that into a little cartoon. Never
Pretty good,
invest in
Don.
any idea you can't illustrate with a crib. There's oil investing. It's simple. It's
I'm
it's
not that
not that
artistic, so I
complicated.
appreciate your team doing that. That's pretty fun. I like it.
Well, with that, students, this is somebody we trust, somebody that we admire, but more than anything, we trust our students with this education. We're glad you're here. Thank you for being here. And take this. We encourage you to take this recording and share it with your friends afterwards. So Troy, turn the time over to you. Thank you so much for being on.
Yes,
We
sir.
appreciate it.
Let's see if I can get it up and running.
And then how do you want to conduct this? Do you want to answer questions throughout, or do you want to
You know
save
what?
them and then
You see a question you
do
want to ask, just jump in and ask me the question, because there's no sense. See, this is the problem. It goes right at the core of due diligence. Take notes on what I'm saying. If you have a question you need to ask it, post it down in the chat. Don will feed it to me. And this is how due diligence works. It's a game of intake of information, regurgitation of what you heard, and comprehension between that conversation and what you heard. And that's really what due diligence is. So one thing I'll make a note, and I think this is a great way to start it, is that I guess I was on last Tuesday or Wednesday, and we had close to 400 people online, plus a lot of people afterwards. But you hold a presentation on due diligence. It's like saying, would you like to show up voluntarily for a root canal? Would you like me to hit your thumb with a hammer? And why is it that due diligence is so unappealing? Because most people don't like the dirty work. Like, when people go buy a car, Don, they go up to the dealership and they go, okay, I'm looking for a truck or car, an SUV, and this is the kind of payment I want, the kind of car I want. And the salesman, if he's any good, is going to go like, well, tell me what you want in mileage, what kind of horsepower, what do you want, 4-cylinder, 6-cylinder, 2-passenger, 4. They're going to ask you specific details to try to match your need with what they have. The typical salesman doesn't care what you need. They know you want a car and this is your payment, and they are going to try to get you into that car because the details are not important to you, so they're not important to him or her. And that's due diligence. Due diligence is about you clearly knowing what you want to achieve and then looking at opportunities to do successful investing in assets with people and in different sectors that match your needs. You don't chase deals. You don't chase assets and investment opportunities because they happen to be the shiniest nickel in the room. So that's just a fundamental, but let's get started with some real meat on the bone, and I'll tell you exactly what we're doing here. All right, so first off,
if you have questions, put them in the Q&A screen. And
yeah,
then,
Q&A.
Yep, okay. And I'll
Be
be in the
perfect.
background.
So
Okay.
the first thing I can tell everyone is that let's just explain what due diligence is, all right? Due diligence is, look at the word, due. You are due or owed diligence with regard to finding out details and facts. The person who is asking you to invest has assumed some type of fiduciary role, a manager's role, or at least the person who has constructed the event that causes you to be considering to make an investment, transferring your money into their care. You could be buying an asset like a mineral right, that's real estate. But if you buy into a mineral rights fund or LLC, that's a whole different ballgame, because now there's all kinds of different levels of responsibility and there's levels of accountability that go with being in different types of investment structures, right? So due diligence, the two words together say, I got to be diligent. That means staying after it, staying the course, being persistent, being detailed. I need that diligence, and it's due to me as the investor who's going to make that decision to invest or not. Now, why do most people not care about due diligence? Well, one of several things. They don't know what to ask. It's a different investment asset class. They ask certain questions and they think, well, by the knowledge that I have, I can only come up with 6 or 8 questions. As the company who's selling the investments begin to talk, your background, your experience, your childhood, your formal education says, well, if they said X, I might want to say Y. I need to have some kind of correlation based on my own experience to even know what to ask, what answer sounds reasonable, and what are the reoccurring or additional questions that I should ask in this due diligence process. Well, I'm going to help you, I hope, understand more about the due diligence from the standpoint of Certain things are very basic, and it applies to any investment asset class. I don't care if it's crypto, life insurance, oil and gas, real estate, it all applies. And fundamentally, it's very simple. Now watch. Think about due diligence like driving from your house to the grocery store, going down the highway. There might be 6 or 7 exits between your house and the grocery store. Those are called off-ramps. And the off-ramps are where you say, I've decided I don't want to go to the grocery store. I thought I wanted to go, but I get to the first off-ramp or exit. I go, you know what? I forgot my wallet. I'm going to go back to the house. I don't have any money to buy it. I get to the second off-ramp and I look at my map on my phone and I go, it's all red. Got to be a wreck. It's the highway shut down. I'm not getting in that mess. I'm going back. It looks too convoluted. It looks too messy. These off-ramps, in my example of driving down the highway to go from your house to the store, are the same kind of off-ramps that occur in investing. I'm going to show you some of those off-ramps. Now, here's the point. Some of you will listen to those off-ramps and stop the process going forward. Many of you will second guess the preponderance of the facts, the preponderance of the diligence, the amount of it. When they give you information, you're going to go, yeah, but it sounds like they're really good guys, but it looks like they got 2 felonies, but they told me that's when they were younger, so those felonies don't count. When you start ignoring the signs that you should be off-ramping, you then have precariously put yourself in a position of almost an assured 100% chance of losing your money or worse. Let's get started. All right. I couldn't put enough categories up here to talk about the different asset classes, but essentially due diligence in my world is looking at alternative investments, alternative assets. So you got debt funds of all kinds, right? People want to raise $10 million to go do second liens, first liens. They want to do bridge loans. They want to buy out distress loans. Now the big deal is buying out distress loans. So debt funds, ATM funds, that's been the hot ticket the last 5 years. Go buy yourself an ATM machine, get a tax write-off. It's going to make you 20, 30% return a year, and you don't own the machine after 7 years. Water stations, like the kind you go fill up your 5-gallon jug. Just found out that looks like a $150 million Ponzi scheme. Got a big tax write-off, making 40% return a year. You've got real estate, oil and gas, car washes, laundromats. You can see the list. And what's the common theme between everything on that list? They're not public securities. You can't buy them and sell them in the public market. You're investing with private individual sponsors, individuals that have created an opportunity. These are assets that don't have really a mark-to-market value. You don't go look online and Google and say, what's the real value or cost of this? It has to be your own interpretation based on the supposed facts you're given. There's not a liquidity opportunity. There's generally not a way to compare one asset versus the other in the same asset class, comparing sponsors. There's not an online website that does it. So this is an alternative asset class, which can be incredibly profitable, but it's also like walking potentially through a field of landmines where if you don't know how to get through it and you don't know exactly what you're doing when it comes to the actual investments and the actual due diligence and the actual asset class, you can shoot your foot off, okay? Now, due diligence steps, there's probably the top 5 or 10 that I would look at all the time with regard to what do I really want to know about this asset. But I'm going to help you tonight and give you really 3 basics. The number one most important thing in due diligence is not whether it's real estate, not self-storage, not oil and gas, not crypto, not car washes. It's the who. And no offense to anybody that may be looking in, and no offense to anybody that may be a mastermind or a guru or they're self-appointed experts. The reality of it is the who is important. When I take a dentist who decided he doesn't want to be behind the chair working on teeth, and now he's a mastermind and an expert at 10 different asset classes, he's been doing it for 2 years, that who matters to me. What basis does that individual have for being an expert? When I go out and I find out there's a mastermind and they're saying, I'm going to collectively get all these people together, charge them a fee, and I'm going to vet as the mastermind all these different products, bring them into my group, and I'm an expert in 10 categories of assets, and I'm going to allow my paying members to be exposed to those assets because I'm an expert. Do you mind showing me your net worth? Do you mind showing me your portfolio? Do you mind showing me the last 10 years of how you created your wealth? Can I run a background check on you and see what your resume says and Are you really who you say you are? But you know what? They don't have to, because they call themselves a mastermind. And everybody out there goes, well, he must be smart. He's a mastermind. That's not really true. What really is, it's Halloween and people get to pretend to be whoever they want to be. And that's sometimes how the boogeyman gets in your house. So for me, the who is the number one due diligence item. In today's world, if I cannot Google your company, your name, your managers, or your team, if I can't Google and find document after document and background and where you worked and companies you've created and things you've done and properties you bought, if I can't Google your name and come up with 5, 10, 20 successful search results, there's a major problem. It's not only a red flag, the house is on fire. That's your first off-ramp. If the who is not clear and it doesn't match the story and it doesn't have more than 3 years or 4 years, because what a lot of people do, they commit crimes, they have bad investments, they go bankrupt, they're felons 5, 6, 8, 10 years ago, and they slightly change their name, change their address. Instead of being Michael Johnson, it becomes MJ Johnson, and nobody does any homework. And it turns out that they're maybe a felon. And you don't know that because you don't find that Michael Johnson, you find MJ Johnson or MJJ double J Johnson or Junior. And so the who is really important. The written questions and answers, let me give you a hint. Why do you want to put it in writing, what you want to ask? Because verbally becomes hearsay. I asked the question, have you ever been sued before for financial default? No. You find out later your investment's not working. You say they promised or they said they'd never been in financial default. Now it's a swearing match. They say, no, what you asked me is, have you been recently seeing any kind of financial default? And I said, no, I didn't lie. I told you, I informed you. So you invested as a wealthy investor, fully well-known. And so therefore it's your loss. It's your risk. You took it, you assumed it, right? When you put something in writing, now when there's something that goes amiss, you can say, well, this is what you wrote. And if it turns out to be factually incorrect, that's called fraud with intent. Now, I'm not a lawyer. I'm just telling you the way I see it. I have had to go after a lot of bad characters, but I have made myself a promise that when I do transactions, I'm flying to Houston tomorrow looking at a $200 million transaction. So I've done a lot of these. And when I go there, I want what they're telling me, what they're describing, what they're representing. I want it in writing. Now, how hard is that if I'm going to go raise money on a self-storage unit? How hard is it really for me to say, oh, I would like to see who your managers are. I want to see a copy of the contract to buy that self-storage. I want to see your documents. When you close, even after you raise the money, I want to see the closing documents to make sure you didn't take an under-the-table commission, you didn't buy it cheaper than what you said in your documents, and you kept the difference. I want to ask you questions, and I want it in writing. Period. Well, we don't put things in writing. Thank you. Have a nice day. Off-ramp number 2. We get down to the motive. Now, look, I've been in the business for 40 years. I like to make a profit. I don't work for free. In fact, what I learned, like with lawyers, you go hire a $200 an hour lawyer and you hire a $1,000 an hour lawyer. And you think, well, I ought to get 5 times the work, or I'd at least get a better value for the more expensive lawyer, or I ought to get this less expensive lawyer is probably not very smart. None of that's true. What's true is the $1,000 lawyer figures out I can charge certain clients who don't ask good questions, are not familiar with the legal process, familiar with the legal profession and the quality of work. They think I'm worth $1,000, so I charge it. But I don't win any more cases than the guy that charges $200. So I need to know the motive. And the motive might be, I'm putting together this joint venture because I need to make a fee so I can eat, put my kids in college like you. I don't want to work for free, or otherwise I could care less how your investment turns out. I also would like to have a potential upside. I want to know maybe I'm earning some equity either before or after you make a certain return or you get paid out. The motive is not necessarily a deal killer, but I believe the sponsor has an obligation to tell you what that motive is. And then that motive has to be something that helps you discern if, in fact, your investment dollars are aligned with the sponsor's interest. And if you really peel back the motive and the fees and the commissions and the sidebar service contracts and the behind the side commissions and the exit value, and I get commission selling the property, I get commission buying the property. Well, what's the real motive? I don't care if the property makes any money. I just need to buy and sell as many properties as I can and charge a whole bunch of management fees, and everybody else loses their money, but I made millions of dollars managing defaulting assets. The motive is highly critical. So think about it. It's the who, it's the willingness to actually answer the questions that I ask, and it's the motive, right? So the goal pre-investing is what? I want to avoid losing money in any investment. And I want to do that by not having correct information. I want the right information that allows me to make an intelligent and informed decision. It's about your right, due diligence. I'm due the answers I ask. They get offended, they get pissy. If they don't want to answer your questions, you simply say, I am so happy that you've decided you do not want to be forthcoming, and therefore I choose to go look at the other thousands of investments that exist while you try to call the next person who I would label a sucker who's willing to have answers not answered, or questions not answered, right? So I want the sponsor, the person who says, this is my joint venture, it's my LLC, it's my organized venture. I want that person to answer my questions. I want them to give me the information, tell me what you know at the time I make the investment. I will make the decision. Then the market will determine the outcome more likely than having somebody who's got ulterior motives, or at least they've hidden the agenda, or they're not forthcoming with all the information, right? So, you say top 10 questions for due diligence. I did this last night. I could have written 100 questions, right? The questions are simple, though. It's really simple. It's like, okay, you're asking me to invest in this self-storage. You're asking me to buy this piece of real estate. You're asking me to buy mineral rights or participate in this oil and gas drilling venture. All right. The questions are simple. Do you currently own the asset you're selling to me? Or are you brokering it? What does that mean? Well, you want to go buy that self-storage for $10 million. Apparently, you don't have the money to close it. You're telling me you've got a hard money deposit or a deposit on a contract. I'd like to see that contract. I want to know, are you on the 85th day of a 90-day contract and you're going to lose your $50,000 earnest money? Or do you not even have any earnest money and you don't have a legitimate contract? You're out presenting as if you have control of that asset. You're out raising money, hoping you can go back and put it under contract. And then we don't even know what the final price is. We don't know what kind of fee you're going to make, and we don't know what the spread is. These are basic questions. Do you own the asset that you actually are selling me? Yes or no? It doesn't matter. I just want to know. Things like, have you ever been involved in an LLC or a company in the last 5 years that has defaulted on a loan or filed bankruptcy? Yes or no? So you look at the chart on the right, you say there's a minimal process. Now, this is a complicated process, but really it's kind of simple. I'm going to look at an asset. I got to know who. I need to know questions to ask. Okay, I need to know your motive. But along that process, certain things you ask and certain required information, you're either going to get some part, all, or none. You have to decide in your total wish list of things that you ask. I get asked a lot of questions sometimes. I had a due diligence group last year, gave me this list. It was like 20 pages long. They said, how will you pay your bills if you don't raise money? And what do you pay your corporate managers? And what fee do you take out of your company? My answer was NA, not applicable, none of your business, not going to answer. And they were like, well, why are you going to answer? I said, because you're buying real estate. You're not buying into my company. It's none of your business how I pay my bills, and it's none of your business what I pay myself. What you need to focus on is the asset and the opportunity you're getting involved in. Now, if you want to ask me, in that particular venture, will it be able to pay its bills by the way you structured it? Will you disclose the contract you signed in selling me into this partnership or JV? No, you don't own it. I'm okay with that. Can you show me, or will you show me the contract that says you have the right to buy it? So as we fund it, we know that you actually have control of it. These are fair questions related to the investment decision that you're being asked to participate in. But there's a whole long series of questions that have to be asked. The questions will vary from opportunity to opportunity. The questions will vary from sponsor to sponsor, asset class to asset class, because some are sponsors that have been around 10 or 20 years. They got a great name. Some sponsors showed up 18 months ago, and you're like, how long you been doing this buy and flip? Oh, I started in 2023 because I think it's a distressed market. I was selling cars, but now I think there's a distressed real estate market. So I'm buying houses and flipping them to guys like you, and I'm going to charge you a fee. And wow, okay, so great. You showed up to the party, and now you want everybody else to believe you're an expert bartender. I don't think so. All right. So what are some of the questions you can ask? I'm not going to go into the micro detail because it gets a little boring, but things like, will you provide, I like asking it this way, will you provide, what's in it for you? What's the motive? I want to know what you're motivated by. The equity, the service contracts, the fees, everything. If it's your side company that's doing all the work on the buy and flip, I need to know that, because are you charging me a fair fee, or is it a market fee, or are you doubling the cost? I want to know what's in it for you. What will you and your firm, or excuse me, will your firm and principals be investing in the same asset? What does that mean? Are you putting any money in? Or did you go buy that? You're selling me 100%, the other investors 100%. You have no skin in the game, so it doesn't matter if it wins or fails. And you have this nice fee up front, you have these nice service fees, and then you have this equity back end. Well, how does that count? Well, it tells me your motive is to do what? To sell 100 deals like that, hoping 10 work and the other 90 might fail, but who cares? You make money when we lose. I need to know these kind of questions. Will you provide the contracts, deeds, proof of ownership, the trail of ownership, all the assets? Will you do that? Will you show it to me? Yes or no? Okay. They can say no, or they can say, I'll give you some, not all. It's worth asking. Look, remember, the smartest thing you can do as an investor, anytime you're talking to a sponsor, say, look, I'm not the smartest person. In fact, I'm probably the dumbest person in the room. So tell me in sixth grade language what you do, answer all these questions, assume I'm the dumbest person in the room. And what I have found in 40 years of working with investors, a lot of them want to come in and say, I'm a chemical engineer, I'm a banker, I'm a lawyer, I'm a financial expert, I'm a CPA. Well, automatically they're trying to position themselves like I'm the smartest person in the room, and you're making an investment into an alternative asset class that may be very unique and very specific. Because you can take a chemical engineer who couldn't tell you which way a drill bit turns on an oil well. You could take a banker, and he may be really smart at banking, but he may not be able to figure out how to do a real estate transaction when it comes to development, because he's used to lending the money. He's never been out there with a shovel and a pickaxe, or never been in the actual weeds, understanding how something's constructed. Okay? So what you've got to do is decide for yourself, regardless of your pedigree and how smart you are. I always have done this for 40 years. I walk around and say, look, I'm a dummy. I'm probably the dumbest guy in the room. I can catch on. Tell me like I'm a sixth grader. Give it to me in small bites. I'm going to ask a bunch of questions that may not make sense, but I just got to get my head around it. I'm serious about investing, but I'm a sponge. So tell me everything you know. And what you've done is you've clearly made the point, even if you're not the dumbest person in the room, you want it to be dumbed down so that way you can understand the working parts. And if you also don't come in with an arrogant attitude, you're likely to get a lot more answers. Now, that may be the answer that tell you you don't want to do it, but at least you'll get the answers, right? So I'm at a huge meeting tomorrow. It's a huge presentation, $200 million asset we're negotiating with a major billion-dollar company. And I'm going to walk in, and I got 40 years experience, and say, you know what? I've got some experience in this. I've got some experience in that. And, we're just deciding if this is something that's too big for us, maybe too small, but I just have some basic questions, and I'd like to get them answered. And, you guys will explain to me what you're doing. I'm not going in there acting like I'm CEO or chairman of the board of Eckerd Enterprises, who's been around for 40 years. Maybe they know I have and they've looked online, but my goal is to walk in tomorrow and say, I want to know every weakness in that asset and every flaw in that asset, because part of my due diligence is to find out if it's as good as I think it is, or does it have too big of ripped holes in the side of the ship and it's about to sink, and I'm only looking at the side of the ship that's perfectly good shape, all right? What will you provide in way of proof of concept? Now watch. I'm going to go buy rent house and flip, and you're going to make 23% return on your money. Can you show me your track record where you've done that? What do you mean? Well, you say you do this. You say you're going to do this. Well, gonna is a great word. Gonna means they've never done it. Gonna means they might do it. Gonna means they hope they do it. What I want to see is your proof of concept. You tell me I can buy a house, double my money in 4 years, flip it out. Please show me any one financial proof of concept you've ever done it before. It's called a track record, folks. Now, at the bottom of every track record, the SEC, state regulators, everybody wants you to put on the bottom, prior performance is no indication of future results. Well, it may not be. But if I want to go buy a really nice quarter horse that wants to be a roping horse, I'd like to know the horse isn't scared of cows. I'd like to know the horse isn't skittish from a rope being thrown over its head. I'd like to know the horse has actually been in competition, maybe had a chance to win or lose. In other words, I need a proof of concept that what I'm about to buy has even remotely been done before, tried and failed, tried and succeeded. I need no proof of concept. Do you have that? Yes or no? Now, it could be a startup. I mean, I started selling minerals 5.5 years ago. We didn't have a mineral portfolio at the time. We had 30-something years of oil and gas experience, but minerals was a brand new asset class for us. And so it was really a serious conversation with our first investors into minerals that said, tell me why minerals make sense and why you can be good at it. And it took a very brick by brick process. Well, those are things when you ask for proof of concept, you then get to measure all the other due diligence items by that response. Oh, they've been around for 30 years. Oh, they do this, they do that. They owned assets. They got a great antecedents, resumes on all their owners. They've got a clear background, no criminals, no liars, no cheats. This is just a new asset class that's evolved. Okay, that's one of the risks, but I'm okay because the other 9 are good out of 10. Will you provide me who owns the company? Because you know what I found over the years? The people who make all the money sit in the background. Their name's never on the company. Their name's never in front. They sit in the background. And at the end of the day, what happens is they're making all the profit and they put stool pigeons up front and they pay that manager 500 grand and this person 300 grand. And they get all their front people raising all the money, telling all these beautiful stories. But when that profit comes in the door, it goes to this 5% owner who has 100% of the voting rights, who has the right to 100% of the net distribution of the company. And guess what I want to know? I want to know everybody that owns your company. I want to know everybody involved, because why? That's what they do. They go out 20 years ago. They create all kinds of bad deals. They have a bad reputation. They've been sued, felonies, criminals, and they come in and start brand new ideas and say, look what I learned in prison. Set up these companies and here we go. Even the legitimate companies need to know who's behind the curtain, who's in your board, who gets the profit. Is it layered with 9 different companies? So when this one goes bad and nobody has a way of having any recourse, it's not really that it's going to kill a deal or make you not want to do it. It's part of the due diligence. You're due to know who owns the company that's sponsoring the asset you're in. Will you provide me a detailed historical track record? What does that mean? Well, don't tell me you raised $10 million and you sold it for $19 million. Well, great. How long did you hold it? How much was your money? How much was the investor money? When did you make distributions? Was it compounded? Was it a single distribution? How much more capital cost did you put in? Did you have subsequent capital costs? A track record should demonstrate investment timing, money in, money out, frequency of distributions, what that rate of return looks like. Taxes should maybe be considered in specific investment asset classes like oil and gas drilling. I know you got a big tax write-off. So is your return based on the net dollar after the tax savings, or does it include the entire amount that I put in? Makes a big difference to me. I think these are the kind of things I want to see in a track record, right? Has anyone in your firm ever been sued, ever been arrested, felonies, misdemeanors, fraud, found guilty by the SEC, banned by state securities board, cease and desist? You better ask that question, because what I'm finding here in the last 6 to 12 months, there's a whole lot of investment asset classes out there right now have been run by felons and frauds and people banned by the SEC and lost their financial planner's license. And what they did was they said, we lost all of our ability to sell, so we just masked ourselves and went forward. And most of these investors that have lost, I'm guessing close to $500 million I've seen in Ponzi schemes in the last 6 months from investors that are my clients, and all these other deals they got in. And it's a common theme. They didn't ask the who. They didn't dig. They didn't get the details. So you better ask specifically in writing, have you or any of your owners, any of your senior management, or anyone affiliated with this asset, are they a felon, or have they been charged as a felon? They've been convicted. Or are they currently under criminal investigation? Yes or no? Answer the question. Do you have any current lawsuits? Why? You don't think there's a lot of lawsuits today? There's a lot of lawsuits being formed. People are not happy that they've got millions and hundreds of millions of dollars in losses. So how come that lawsuit matters? Well, if you're selling a new investment, but they're being sued by all these other investors, those other investors might win, which means this manager could be out of business. This manager who has great intentions on the investment you're thinking about investing in, he can't stay in business if he loses this lawsuit. I need to know there's a detrimental failure switch that may happen. It's another off-ramp. You can't survive if they win. And by the way, why did they sue you? Can you disclose the lawsuit? Tell me the terms. Can you show me your response to the lawsuit? These things are really critical, okay? Post-investing, this is where I think today is. Today is really a sad day because so many investors are in these sticky deals and they don't know what their rights are. They have no clue. They're like, well, can I call them and ask them to show me why they're making a cash call? They haven't sent out financials lately, but they're asking me to put more money in. Do I have the right to ask them? Like, what do you mean, do you have the right? Look at your documents. Oh, I haven't read those. So one of the things you got to remember is when you sign up as an accredited investor, you sign up in a lot of these ventures, there's indemnifications, there's disclosures, there's right to fees, there's all kinds of covenants, there's voting rights. There's a lot of things you signed up to that all of a sudden now the person who sold you the investment is going to use those as a weapon of defense against you getting information. I have kind of a simple statement. I've said this for years. The thicker the document, the worse the deal. Now that may be the opposite of what you're thinking. Somebody hands you two pieces of pieces of paper and says, here's a transaction to buy a mineral right. Here's a transaction to buy a rent house. Here's a transaction to buy into a self-storage with 10 other people into a simple LLC. This is your LLC document. You go 2 pages. Where's the rest of the documents? The thicker the document gets, remember this, that document's thick because the person making the offer, the sponsor asking you to invest in their project, has paid a law firm to protect them. I need lots of disclosure, lots of identification. I want to make sure they can't vote. I want to make sure they can't remove me as manager. I want to make sure they can't ask me for financials just whenever they want. I got to have in there that if they do ask for financials, maybe I've got to give them, they got to give me a 90-day notice, and it only has to be on Fridays ending in Z. You look at that document, the thicker it gets, to my view, 40 years of experience, the thicker the document, the more it needs to go in the trash can. Now, that's not always the case, so don't just take a general assumption. I've got a project. We did a pipeline in December. The document was this thick. Why? Because it was very complex and it had a lot of disclosures from the result of the asset itself. The book got thick. I hate them. So not every deal is dead because it's thick, but just remember, in most cases, the thicker the deal, the more the person selling the deal is covering their own backside. Kind of just a little short analogy, right? So I wrote this, may not make any sense. I probably made some misspells. I'm not a great speller. An investment with a sponsor is a business decision, okay? It's a decision, like a marriage. I've decided to get engaged with you and marry you. I'm going to marry you for the term of this investment. It's a 5-year hold, 3-year hold, preferred return, right? That decision comes with obligations and expectations of the sponsor. Why the sponsor, not the investor? The investor only has one rule. Be faithful and truthful about your qualification as a sophisticated investor and a financially qualified investor. I'm accredited and I've been investing for 10 years. I'm going to invest in your project. So I qualify. I have money and I want to invest. But what is the sponsor's obligation? To be truthful, give me financial reporting, proactive in communications, transparency. You're legally required to give it to me under a lot of SEC standards. There's certain requirements under state law. So there's a lot of things each one of these sponsors are required to do and to provide and to perform, especially those that are in LLCs and special purpose vehicles, because most likely they've assumed the role as a fiduciary manager, a manager with fiduciary rights, and they owe more rights to their investors than they do their own spouse in a marriage. So this is a business decision, but there are assumed and legal constraints and obligations, and there's all types of things that are tied to being a sponsor, which most of these people either don't know or they do know, and they know you don't know. You need to ask and you need to find out what your obligations are, okay? Sorry, my timer's going off. I want to kill that real quick. All right, now, I'm going to go through about 5 or 6 asset classes, do it fairly quickly so we leave ourselves some time, all right? These are some assets that have been sold the last 5 or 6 years. Carbon capture, ATM business machines, ice machines, and car washes. Well, car washes are good. Car wash is a business more than a piece of real estate. People think when they buy a car wash, they're buying a piece of real estate. Oh, we bought this car wash for $5.7 million based on the EBITDA and the cash flow. Really, if that car wash goes out of business, you own a piece of real estate. And there has to be some kind of value separating the two, right? But what happened to these particular asset classes is specifically because President Trump put in this big tax reduction act, everything was driven by tax write-off. If you buy a piece of equipment, you get to write it off 100% that year. Well, here comes the ATM sales. Here comes the carbon capture. You get 100% write-off and you get all these tax credits on it, right? Ice machines, car washes, blah, 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 water machines. Well, it turned out everybody chased that irresistible bait, which was 100% tax write-off. A tax write-off is the greatest tool scammers use. If I've got to pitch you on a tax write-off, what does the definition from an IRS mean? A tax write-off means you're going to lose your money. I can't write it off unless I lose it, right? If you're telling me I need a write-off in this asset, it means I'm not going to make money. And all I've done is I've dressed a pig up by putting a nice wig on and some lipstick and said, it's not really a pig, it's a tax write-off. Well, these particular asset classes are turning out to be some of the biggest Ponzi schemes and failures that are out there. And there's a lot of people out there still thinking they've got ATM machines and water machines and ice machines and car washes. I'm not saying all of them, but I'd be asking for the books and the balance, and I want to find out what really exists underneath the curtain, because quite frankly, my experience the last 18 to 36 months is the majority of these have turned out to be Ponzi schemes, and the sponsors know it, they knew it, and now they're basically fleeing, right? What about water stations, conservation easements, cryptocurrency, laundromats? A laundromat's a piece of real estate. It also happens to be a business if you own the real estate. What if you don't own the real estate? Well, then you bought a business. How many of you are really skilled at running a laundromat? How many of you are really skilled at buying crypto? Where is crypto? Where's my coin? Where does it exist? Is it offshore, onshore? What about Sam Fry? $20 billion fraud. I don't even know where the money is. I didn't know who made the crypto. I didn't know what a Bitcoin looks like, right? So you got to start looking for these particular exotic different investments. You can make a lot of money, but there's always one guy that runs out of the casino saying, I made a lot of money. Well, how many times did you come that you lost your shirt? Oh, 9 out of 10 times, but this time I'm a winner. It's the inability to find public data that bothers most investors, right? So if you can't find public data about the value or a comparison asset to asset, or maybe there's not a source that you can go find out everything you want to know about conservation easements, which, by the way, the number one most auditable investment the IRS has been going after the last 2 years, because everybody knew they were not going to do work. Everybody knew conservation easements, for the most part, were being run by people who raised a ton of money, and they put it in conservation easements, supposedly, and the IRS is discounting. That is a massive, massive failure of just simply looking at the fundamental basis. If something's too complex or too exotic, maybe you shouldn't do it. All right, we get into some other things. These are alternative asset classes. What I do, oil and gas, non-public offerings, private stock offerings. A lot of startups made it really big in the .com and all the current tech companies, right? You never know when you land a Facebook, but you might have to invest in 20 for one to work. You got real estate syndications. There's been a lot of successful ones. There's a lot of them that are having a lot of trouble right now. You got debt funds. Those debt funds are, in my view today, are dynamite in your hand because everybody's running for redemptions. The asset values are going down. The distributions are going down, and it's a powder keg. But these are asset classes, and they're alternative, but the questions are the same. It's the who, it's the questions, it's the motive, it's the experience, it's what you've been doing. All right, now, simplicity. If the opportunity cannot be fully verified, assume it's not true. If you can't tell me your background, your resume, what you've done in the last 5 years, a track record, a proof of concept, answer questions, give it to me in writing, and then it can't be true, and therefore I'm going to politely say, really appreciate it, you sound like a nice guy, and the answer is no, and you can take me off your list. Yeah, but let me cut. The answer is no, take me off your list. See, one of the things I've learned now that I'm about to be 60 years old, it is so easy to say, no, thank you. Troy, would you like to look at this? No, thank you. Why not? I just don't do that. It's not in my wheelhouse. See this desk up here on the screen? It's real small. Can't hold a lot of packages. I'm going to have 2 or 3 things I invest in, and that's about it. Now, I'll listen to you until I have an off-ramp. I'll listen to you as long as it fits what I'm trying to do. And as long as you're answering the questions and I can see that what you're doing stays in my side rails, it fits what I'm trying to do, you're being cooperative and helping me run my due diligence, well, I might look at a new asset class. But absent that, I got a little bitty space on my desk, and I'm not going to do anything except look at it. Now, this is a briefcase, right? So whether it's a desk or a briefcase, if it doesn't fit in the briefcase, I can't look at it. Well, I only have room for 2 or 3 deals in that briefcase, right? On my desk, I got a little bitty desk. That's all I have room for. If the who cannot be verified, the first question you ask is verification of the who. If you cannot absolutely verify the who and run a background check. So I get clients that send me due diligence, and when they do, I say, who are you investing with? Who are they? First thing I do is I take the company, I look it up. If I can't find the management, I say, can't find the management, it goes in the trash. I find management. I take the client, the person's name, full name, I put it in broker search under FINRA or SEC. I put it under, and I write down Johnny Brown, con artist, liar, fraud, SEC violation, cease and desist, all in the URL line. Watch what comes out. And about second, third page down, second, third note down, here comes that felony conviction, SEC warrant, whatever. And let me tell you why. When you're out stealing money or you're doing bad deals, most of it's profit. I can pay anybody in social media or anybody that's going to run a search engine optimization, and I can take up the first 2 to 3 to 6 pages of my name and my record that I'm the smartest, most honest guy in the world because I'm making so much money because maybe I'm stealing it, maybe I'm stealing most of it, maybe I'm stealing all of it, but I have all the money in the world to spend to create a facade of who I am. You got to go deep. You got to put the name, the company, and dig deep. And if you cannot find anything bad, that's great news. If you can't find anything at all, you got a problem. You need a ditch. All right, we're almost at the end. So in due diligence, let me ask you this. This is the way I feel about it. Do you jump out of an airplane without checking your own parachute? Clients will call and say, I put $1 million in last year and I didn't know what I bought into. You already jumped out of the plane. What am I going to do for you? I mean, I'm going to well, you better start finding a landing spot, right? There's thousands of hours for you to make the money that you have to invest, and you lose it in seconds because you won't do the most basic fundamental things. It's not that hard. Okay, you've got to protect your wealth. You got to protect your money. You got to protect it for your family, your kiddos, your wife, your spouse, your parents. You've got to take a serious look at due diligence, just like you do in making the money in the first place, right? So here's Eckerd, 1985, been around forever. I'll be 60 years old next month. I've had 40 years experience, 4 decades in oil and gas. I'm about the most transparent, hardcore, blunt company you'll ever deal with. I love training and educating on due diligence because I don't want you to lose your money with me or anybody else. I want you to be successful, because once you start seeing failure and bad actors and Ponzi schemes and bankruptcies like we're experiencing now, everybody recoils. They go into hiding. They hunker down. They go, I don't trust anybody. I'm not going to make any investments. I got burned in 5 multifamily and 2 cryptos and a carbon sequestration that's a Ponzi scheme. So I'm just not investing. I'm just going to sit and freeze. See, I want people to invest to be successful, but I want you to be smart about it with right due diligence. All right. So when I think about our company, it's real simple. You go online, you find www.eckerdenterprise.com, and what you're going to see is the way we do our business is face-to-face, total access, total transparency, field trips, conferences, education, information. We do all of this because one reason is why. Due diligence should be tied to sincerity. Do you sincerely want me as your investor? Do you want to sincerely have me as your partner? And if that's not the case, if you don't feel like that, if you're not getting information flow, then what you have is you have a problem. This is a QR code if you'd like to link in to learn more about Eckerd. We have Eckerd Insights. You can sign up to our app, full of videos and educational information, hours and hours of hearing my boring voice, but it's going to teach you about debt funds and real estate and Ponzi schemes. It is an entire amount of videos and recordings of education, and it's not just oil and gas. It's about lots of asset classes, lots of topics, because why? I want you to be the smartest investor that is out there, because I don't want you losing because you got taken advantage of. All right. That's all I've got. That's the end of my presentation. And I know there's some Q&A questions down there. I guess Don, maybe you can read them, right? I can pull it up real quick and take a look.
You know what? Thank you, Troy. We had some questions about why we were doing this. And my response to my staff is, look, protecting wealth is more than just setting up legal entities and saving money on taxes and doing estate planning. You don't want to lose money along the way. That has to include due diligence. So Troy, great information. Okay.
You want me to tackle any of the questions, or just let them go because we're running out of time? I don't know what time it is, to be honest with you. Or you want to try to tackle a couple of questions?
Yeah, let's do it. As a passive investor, I do not want to be liable for anything more than my initial investment. Does a limited partner have any liabilities? I think what they're asking.
Yeah, I would say, first off, you want to get a legal opinion on that, but I'll give you a 40-year career opinion. Generally speaking, you become a limited partner. You're limited to the amount of money you invested in that venture, right? They can make cash calls. They can have all kinds of liability issues, but you're truly limited. You can get diluted in ownership. You can lose some value as a result of not making capital calls, but you're not obligated to do so. That's true even under LLCs. Now, each one of these have operating agreements, limited partnership agreements. There's all kind of nuances, but from a general limited partnership standpoint, that's the case. It's the same case like in buying mineral rights, though, with our company. When you buy mineral rights, it's a one-time check. You assume no liability for drilling exposure. So even though it's real estate, it's not a limited partnership. There's no liability attached with it. So it's really important, if that's really your risk profile, then your first question should be, anytime anybody calls you, is, I only invest in anything that limits my liability to one check. I don't want cash calls. I don't want liability. I don't want exposure. So please tell me if that's true or not. If they say, well, no, you're going to have some exposure, then it goes in the bank. That's your first off ramp. So questionnaire number 1, your off ramp is, I want no liability beyond my investment. That's your off ramp.
There we go. Well, the only time that I've really seen this breached is when your brother-in-law is putting together an investment, and the limited partners are all family members, and they start exercising control. When you're exercising control and acting as a general partner, then you inherit the liability of the general partner. But as long as you're staying passive, as long as I'm acting as a member, not a manager, I'm acting as a limited partner, not a general partner. You start acting and exercising control, and you are going to inherit some liability.
Yeah, there was a Ponzi scheme 3 years ago, Don, where 2 guys jumped in thinking they were going to take over the Ponzi scheme and try to run it all. And I said, they were real aggressive. And I said, hey, you know what the problem you guys have? And they said, what's that? You now have taken over. You just assumed the right of a general managing member. You just lost all your liability. Now each one of these members can sue you if you don't make the right action. You just went right out of the frying pan into the fire, and they're like, oh my gosh, yep, you just jumped right in the fire, my boys. So it is something you have to be aware of for sure.
Marta is saying if you ask written questions
Yep,
and they lie to you,
yep.
what's your recourse?
Well, if the investment's bad and you asked questions, they wrote you answers that turned out to be materially false or incorrect. I'm not a lawyer. Well, then you probably have grounds for fraud with intent, right? Fraud with intent is very difficult to prove. I've only been successful suing people with fraud with intent. It's hard to prove, right? But if you get them to put it in writing, most likely people are going to commit fraud or do bad acts, aren't going to put it in writing. But if they put it in writing and it turns out to be incorrect because the market shifted, well, that's one thing. That's subjective. But if it's like, I've never been arrested, and it turns out they've been a 10-year career felon, that's fraud with intent and misrepresentation. Then you have a lawyer who will look at that and say, keep in mind, folks, the biggest problem with lawsuits, they're always going to ask you what your damages are. If you go over and try to sue somebody who is broke, you're wasting money because you're trying to get a three-legged horse to run. If you're going to go spend $200,000 to recover $50,000, it's an uneconomical plan. So part of it, these questions about liability also has to do with what's the outcome? I can't waste my time on false misrepresentation because the investments failed, but most likely they failed and they're probably broke too, most likely. So what's happened is you've had some failure in your due diligence and that the questions were just one part of it and they got to you. It happens. And unfortunately, that's the case.
Well, and we talk a lot about states that offer enhanced asset protection, Nevada, Wyoming, Delaware, even though, and you know, we'd say stronger corporate veil, stronger charging order protection, but even those states, that's usually the only way. Fraud with the intent, and if you can prove that, you can pierce. I don't care if it's domestic. I don't care if it's international. If there's fraud involved, you can rip through and go after personal assets.
That's correct. You can chase stolen money anywhere, anytime, any place. If you can prove this, it was stolen with fraud with intent, it's a criminal conviction. And I've been successful in doing that. It's tough to do, and you got to be a tenacious little bulldog, but it does happen. You can get it done. I think Brian asked a pretty complex question. Probably can't answer his question online. It looks like it's quite lengthy and goes into multiple tier investments. I don't know if we can tackle that tonight, just in reading through it a while ago. We dropped down to anonymous attendee. All the questions you asked make lots of sense. Problem is, I won't remember any of it tomorrow. Do you have a comprehensive sheet? So we're going to provide the due diligence PowerPoint. I also am creating a due diligence ebook that'll be done in about 30 days, and it'll cover all of this plus additional questions. It'll give you links to the SEC, FINRA broker check, et cetera. So probably by the end of July, we'll have an ebook you can find on Eckert Enterprises website. I'll share that with Don and his group, and this will apply to any asset class and really be inclusive. We found a lot more of our own personal clients are really asking because of our background and our extensive. I had my own broker dealer for about 22 years. So I was looking at due diligence on Wall Street products and assets. So I had a pretty extensive background on that. At least I felt like I was pretty good at what I did. I will bring all that to bear along with our asset and everything else I described tonight in that ebook. Hopefully be ready on or before August the 1st.
Yeah, and you can always come back and rewatch this video. Again, the recording will be out tomorrow. We'll email it to everyone who registered. We're going to give a copy to Troy and his staff so they can cut it up and do whatever they want to do with it. It'll be posted on YouTube. And when you get to those questions, those 10 questions, you can take a little snip and put it somewhere, but
and I just put my phone number in the chat room. I always put my cell phone number down. So if you want to send me any questions by cell phone, send them to me. I get a couple hundred a day, but I answer them generally all by the time the day's out. So that plus my office number if you have any additional questions.
Are there things to watch out after you get into an investment?
Absolutely. So this is like dating. Everybody puts on their first best behavior on that first date. They don't get really comfortable about the third, fifth, sixth date. And you really don't know what you have until you've been married for a year or two. Then you go, now I know what I've married, right? Could be good, could be bad. The things I look for is differences in what they said before the investment and after. Okay. I look for communication faltering. If they tell me they're going to send out a report once a month and it's been 6 weeks, that's not once a month. It's the subtleties that they do that make the biggest difference. And the sooner, and I'm going to stress this to every one of you, the sooner you put your foot down when a sponsor does not fulfill their end of the bargain, the better chance you have of getting out of a bad deal, asking for your money to be returned, or finding out they're basically a fraud or default. And once you find out somebody in these investments is not going to perform, the sooner you take action, the better. Because while everybody's vacillating about, they won't respond to us, they won't talk to us, they've taken down their website, they're taking that money, that stolen money, and they're putting it in crypto and Bitcoin in other countries. And they may go to jail for 5 or 6 years, but they're coming out with 10 or $20 million in the bank. It happens all the time. So the thing you want to do is say, here's when I went on my first date. This is what they said they're going to do. Now they've got my money. Now they got my phone number. Now they don't call me like they said. They call me later than they said. They don't call me for a week. I'm not getting that financial report. I was supposed to get my check on the 20th of every month. I got my check the 28th. This month I got the check on the 5th of the next month. Those kind of things tell me what? Back office problems, inconsistency, cash flow problems. They don't have good control of their asset. These subtleties are incredibly important. Getting you a copy of your executed contract. When I subscribe to something, send you my check, I want my copy of my contract and my check. I want to know I've been onboarded. I want to know that I own it. I want you to send me copies of what I own. If that's taking a long time, they're telling you in the back office, it probably looks like a first grade kitchen back there throwing mashed potatoes together. There's probably peelings all over the ceiling.
Yeah, I've had people that call me and say, I'm not getting my monthly distributions. They just stop. So do you think I'm going to get my $300,000 back, the balloon payment at the end of 2 years? Well, if you no.
Yeah, there's not a tooth fairy. There's not a tooth fairy out there, and there's Santa Claus is not real. So you got to. And the thing is, you can't be so you don't want to be an obnoxious jerk, Don. But you got to be assertive. You got to say, I expect an answer. Well, should I give them 2 or 3 weeks? No. They, as sponsors, for the most part, owe you a duty and responsibility to give you answers on a fair time frame, right? So if somebody called today and said, Troy, I want to do an audit on your last mineral package. Great. What would you like to do? I want to bring my CPA in, et cetera. Okay. How much do you want to dig into? Well, I want to look at 3 out of my 10 portfolios. Great. What day do you want to come in? Well, I want to come in next Friday at 10 o'clock. Great. I have an opening. I'll assign one person to you. I got 2 hours in the conference room. Go ahead and come in. See, if most sponsors, what they want to do is show you that they're honest. So they'll invest more and you bring more referrals and friends. If they don't show you, it's because they don't want you looking what's behind the kitchen door. Cockroaches and bad stuff go behind that kitchen door, right? We got like 1 minute left, Don. Maybe one more question, then we'll do a follow-up.
Okay.
I think it says, are your investment opportunities accept 1031? Mineral rights are considered real estate. They do qualify for 1031 exchange. And we do several, probably last year, $20-30 million in 1031 exchanges. Looks like we're on par for doing maybe $30 million or more in minerals. It's 1031 exchange. And it's a great exchange item because it's cash flowing from day one with no risk, no liability, and no holding costs. Blah, blah, blah. That's my sales pitch. But yeah, it is available for 1031. The ebook does not require you to be a member.
I'm glad you started off with the who. Because again, hundreds of times, the contract, when you read the contract, who are you dealing with? The contract is only as good as the people who signed it. Oh, yeah. I didn't think about that. Yeah. I don't care about the contract. Yep.
I care about who's, some of my richest clients, I had a billionaire as a client who passed away a few years ago, and he said, I don't even care about the contract, because if you're a liar and a crook, you're gonna do whatever you want to because the contract means nothing to you. I want to know who you are, where you come from. I want your background. I'm not talking the last 3 years. I want to know what you've been doing the last 10, 20 years, because that's who I'm actually signing a contract with, is you, not the piece of paper on my desk.
There you go. And with that, students, we so appreciate it. Troy, appreciate you very much.
Yes, sir. Y'all have a great evening. If you need anything, Don, you know how to get hold of me. And for everybody else out there, just go to Eckerd Insights on our website. It's an educational platform. You don't have to invest. It's free. The ebook's free. Look, folks, I want you to be successful and win. I want you to make a lot of money. But there's a lot of alligators in that water out there, and they've been really chewing on some legs the last 3 years, and the party's not over yet. There's still a lot of people that are doing these distress funds. They're coming out and they're showing up to the party because as long as there's money and people that won't do the due diligence and they're being very careless, you're going to get taken. That's the thing you got to worry about, because it's really hard to make that money. Don, you guys have a great night. I'm headed on vacation for about 10 days, so I'm going to look really relaxed when I get back in about 10 days. So you guys enjoy yourself. Take care.
Appreciate it. Thanks, Troy. Thanks, students, for being on. Have a great night. Bye-bye.